For the next week or so, we're going to talk about chapters 13 and 5, which will use the expenditure cycle as a basis for learning some additional techniques in Microsoft Access. So just as we did on the revenue cycle, we'll talk about 3 sub-cycles, sub-processes: the purchasing process itself, the return of purchases, and the cash disbursement process. We'll then talk about using technology, some of the ways that technology is used in the purchasing cycle. And then we'll talk about how do you go about doing a logical and a physical design for the purchasing cycle, and then talk about some of the Microsoft Access objects. Putting it in context, purchasing is one of the business processes that ultimately feeds the general ledger. You notice there are 2 different purchasing cycles. We're really focused on one. You can either be purchasing kind of raw materials and things of that nature, or you could be purchasing people, that's payroll, or you could be purchasing fixed assets, building a new factory. That's not in this chapter. We'll talk a little bit about that afterwards. So we're talking specifically about the purchase of raw materials, or if you're a merchandiser, the purchase of merchandise that you ultimately go and sell. Does everybody know what a merchandiser is versus a manufacturer? A merchandiser is a reseller, like Macy's is a merchandiser. Their added values, they provide you a forum to buy in. A manufacturer's added values, they take raw materials, do some magical things to them, and turn them into a finished good that they can then sell. Okay, so the expenditure process. It begins with a request for goods and services, and it ends with a payment of cash. So that's the overall cycle. As the purchaser, you have 2 objectives. You want to buy the highest quality goods at the best possible price, and then you want to make your payments at the optimal time. When I went to graduate school, I believe that in every class you take, you go and remember one thing and one thing only in 20 years, if you're lucky, if the professor's lucky. When I took accounting in graduate school, the one thing I remember is pay your bills as late as you can without having to pay a penalty. That's what's lasted in my life for however many years it's been since school. So that's the optimal time, pay without a penalty. And with automated payment now, going through Chase or whatever, you can do that very easily. Information coming out of the expenditure process goes to your recording systems. You have to focus on accounts payable and cash disbursement, and it has a direct impact on inventory. Just as the revenue cycle impacts inventory because you reduce inventory when you sell something, the purchasing cycle increases inventory when you buy something. So if we look at the various events in the purchasing cycle, it begins with something called a REC, a purchasing requisition. How many of you have worked for a company where you've heard the term REC, R-E-Q? The REC comes from an individual department. I need new magic markers, or whatever it might be. And you have that REC from the department. They don't get to, generally speaking, the department doesn't get to buy on their own. There's a purchasing department that accumulates these requests and does the actual process of finding the best product for the company. So the purchasing department would solicit bids on the RECs, accumulating them where appropriate, identifying the potential vendors, etc. Eventually a vendor is selected, and an order is placed, and that purchase is tracked. Ultimately, it will come to the receiving dock, and it is received by the receiving dock department, or the receiving department. And at that point, you have the goods, and you're liable for payment. So you'll record and track the payable. You'll ultimately make your payments.
You'll update accounts payable, cash inventory, and any expense databases. You'll maintain your records on your vendors. Did they ship to you on a timely fashion? Were the quality of the goods the quality you wanted, etc.? So you determine who your good vendors are and who aren't. And very importantly, you'll make your forecasts. This will go into your manufacturing systems. They'll go into your cash management systems to make sure you have enough cash to pay your bills going forward. And so they become part of your analyses at the end. Some of the inputs to the expenditure cycle are recs, your purchase order. So once after the rec goes out and the purchasing department determines which vendor to sell to, or to buy from, excuse me, they will produce a purchase order. It could be paper-based and be sent to them, or it could be online if you have an automated link to your vendors. That purchase order is the request for purchase. The invoice comes back to you saying you owe us this money. The receiving report logs the goods that have come into the receiving department. A bill of lading. How many of you know what a bill of lading is from any other courses? Anybody? Well, this is actually quite often when you ship through a third party. And so the third party, once it gets loaded onto their trucks, they know what's on their truck, and they assume responsibility for the goods while it's on their vehicle in case they get into an accident or they have it stolen from them. So that bill of lading says what's on their truck. And so for that period of time between the vendor and the buyer, it's the shipper who's taking responsibility through the bill of lading. The packing slip, you've all seen packing slips if you buy something from Amazon. It comes in the box, it tells you what's in the box. That's a packing slip. Some of the outputs, you write a check to the vendor, or you wire money, as the case may be. A register of all your checks that will go into cash management. Any discrepancy reports. We'll talk about this later, but there's a very important three-way match that happens during the purchasing cycle. Your purchase order, which is your request for goods. The invoice, which is the vendors saying, here's what I shipped you, you have to pay me now. And your receiving report, which is here's what came into my door. Those things should match. And so the three-way match, if there are discrepancies, you need to figure them out and work with that. Then your cash requirement forecast, I think we talked about that. And financial statements. Okay, so let's think about that receiving clerk, the person who's counting the stuff that comes in. Why should a receiving clerk be denied access to information on a purchase order? There's an assumption here that they should be denied access to the information. Why? Could be collusion, sure. It doesn't always have to be fraud. So if a receiving clerk knew, hey, we should be getting 12 pallets of magic markers this week, and it comes in, they see the purchase order, 12 pallets, it comes in, it looks like it's 12 full pallets. Okay, we're good. Instead, they need to count it and verify it and not know what the right answer is supposed to be. When you know the right answer, you don't tend to work as hard. So it's to keep, it could be because of fraud, or it could just be because of the natural tendency not to work as hard as you can. So what are some of the risks in the expenditure process? Just like we had them in the revenue process. Some products are difficult to differentiate, count, or inspect. Let's say you're a buyer of diamonds. They have a high value, and you need to have a really good eye to know whether it's the grade and the size and all that stuff. So you need to have products, you need to be able to have experts who can differentiate, count, or inspect. You're probably not going to have a receiving doc doing that for you. You'll have one of your important people who understand the industry. If you have a high volume of products, really counting all of that is difficult. And if you have high value products, the importance of getting it right is both in terms of volume and in terms of quality is very important. Diamonds are a good example for that. Pricing, when you buy something, if there are complex prices or based on estimates, or prices change frequently, like oil. What's one of the only airlines to make money regularly? What's the only airline to make money regularly? Southwest, right? Anybody know what they do better than everyone else? They do a few things. What's one of the things they do better? They hedge their jet fuel better than anyone else. They do other things. They have all the same kind of planes, so they reduce their maintenance costs. But the one that matters for us is they hedge jet fuel. Vendors, if you rely on one or a few vendors, you're at risk. I have a buddy who is in the postcard business, high-end postcards for whatever, which is obviously a dying business anyway, and he knows that. But it wasn't a dying business before. He had, to make these high-end postcards, he had one vendor who created this unique postcard for him in London. The vendor went out of business. He was nearly out of business, right? And anytime you have distributed processes, you need to have controls in place to manage those processes correctly. Whether it's receiving or record keeping or cash management, all of those processes need to be managed even more if they're distributed. Okay, the second sub-process is the returns process. In the world of the internet, I think we've talked about this, these are more likely to happen as people are buying goods without the tactile ability to feel them, and etc. So companies are accepting returns more frequently. Now the reasons for returns could be anything, right? It could be the quantity was wrong or the quality was wrong. It was damaged or defective. The delivery, I'm not sure what I mean by errors in delivery, but maybe it was delivered to the wrong location. And the timing issues. It came, but it was too late. You didn't need it anymore. And my daughter's prom dress, if it came after the prom, I'm going to return it. It didn't happen, just saying. Or you just change your mind. In today's day and age, if you're a good customer and the vendor wants to keep your business, if you change your mind, they're going to take it back as long as you didn't do damage to the goods. So returns happen more and more frequently. And what is the name of the document that happens in a return? What happens when you return a good? The vendor has to pay you back. It's money coming in. Cash disbursement. Probably the area that needs the greatest control of any area in a company. And so we talk about control processes in a couple of weeks. Cash is very important because you might want to steal inventory. The receiving department might want to steal your goods, but everybody wants money, right? It's easiest. And in today's day and age, cash is a little bit harder to steal because we're not carrying cash around as much. But also in today's day and age, because of computer hacking, it's that much more dangerous. When somebody does steal money, the numbers are bigger, the amounts are bigger. So you're going to have cash management, remittance advices for your payments, and cash disbursement journals. The remittance advice is the turnaround document. You get the bill from the vendor, you write them a check, and you send the remittance advice back to them with the check saying, I'm paying this invoice. You see it all the time. Any system. Authorization of transactions. You don't want the same person authorizing the transaction as the person writing the check. So that's segregation of duties, but you want to have somebody authorize the transaction. And you want to have segregation of duties. That authorizer is a different person than the person writing the check. You want to make sure your audit trails are strong. You want to make sure your data and your assets and your documents are all well secured. If it's true cash, you have lockboxes and things of that nature. And then from time to time, you have independent checks and reconciliations. I'm not going to go too far into this today because we're going to have sessions on it. But suffice it to say that in banks, there's a rule that tellers have to take 2-week vacations. or at least they used to be. Probably still is. And the purpose there is to see if there's any unusual activity. Use those 2 weeks to understand what's going on in their absence. Now, in all of this, you have to think about the cost-benefit of building these controls. What industry or what area of business do you think has the highest problem with fraud? Banks, but they have such controls. I mean, they know they have to solve that problem. It would be surprising. So certainly cash-based businesses would have more risk. The food industry has some risk. Tends to be more inventory pilferage than cash, but also cash, because at least in the past, restaurants you'd pay more cash. Now you tend to pay with credit card. Not-for-profits, the local PTA. Why are they doing that? Well, let's start off with, if I'm going to give money to a charity, I want to know that charity is spending 98% of my money on the cause, cancer or whatever that might be. And you don't want them spending the money on building controls and people watching people, right? That's what we all think. So it's not like the American Cancer Society has a problem. They're big enough. They're spending a lot of their money on the controls. But the local PTA, where there are very few controls built in, and they deal with a lot of cash. And you always hear the story of, the mother next door who's stolen money. The soccer, yeah. So not-for-profits are a great risk of this because people don't want to spend money on these types of things. A lot of them are so small they don't even know how to, and that's where problems occur. Okay, debate this logic. The person responsible for approving cash disbursements should also prepare the bank reconciliations because she is most familiar with the checks that have been written on that account. Segregation of duties. You want to have different people so you have a check and balance in that process. Okay, the three-way match. We already defined it. It's between the purchase order, the invoice, and the receiving report. They need to match. If it's done manually, which is the historic way of doing it, it's time-consuming. If you do it in an automated fashion, it takes a lot of the work out of it. So when we think about how to use IT in the purchasing cycle, one of the ways you think about it is to enable the three-way match. We'll talk about two different models. One's called computer-based matching, and the other is evaluated receipt settlement, ERS. Then we'll talk about electronic purchases and payments, etc. So this is the match using an old flow chart. You have your invoice, your purchase order, and your receiving report. The three papers come together. You have a person doing a process. You have to sort them all and match them up, find problems, and if there are problems, you have to loop back either to the vendor or to the purchasing department or the receiving department. And that's a slower process. You can do that through a computer if you're dealing with your vendor through an automated system. They could send the invoice. Certainly the purchase orders and the receiving reports could be automated within your company. And that match is a relatively easy thing for a computer to do. The advantages of that are it saves time, it saves money, it reduces error, and it makes sure you don't make payments you shouldn't make. Some of the risks, as we see every day now, it's just more and more challenging, is anytime you automate, particularly when you automate outside of your company, you're running the risk of getting invaded. So security and confidentiality of your information. Processing integrity, making sure that your computer systems work and they're up. If you rely on a computer system and it's down, you have a problem. There's always a risk of fraud. With computer systems, frauds are bigger. The risks associated with fraud are greater. And of course, you always need to back up your files. So those are risks. Probably the advantages outweigh the risks, I would say, for most companies. Another model is something called ERS. I believe it was begun by Ford with some of its vendors. And the concept is, if you have a purchase order and your receiving department matches to your purchase order, you don't really need an invoice if you have a strong relationship with your vendor. You asked for something, you got it, you had a predetermined relationship with that vendor that talks about price and things of that nature. So it's an invoiceless environment where you just send out the check or the wire transfer, whatever it's going to be. Same kinds of risks as you have elsewhere, but this is useful for close relationships with your vendors. Procurement cards, really, if you think about automated links between any company and its vendor, the invoice and the payment could both be automated. On a smaller scale, you have these things called P cards. Have any of you ever had a P card? Essentially, it's a credit card provided by your company to you for petty cash type purchases. You're not going to buy, major inventory purchases on that, but the company will give you a credit card to make small dollar purchases without high risk to the company. RFID tags, we talked about that earlier. Critical for things like just-in-time. I mean, we think about just-in-time inventory management. We think about, you're buying raw materials and they're really close by and you order it and they're there the next day. One of the first projects I ever did many, many years ago was when Nissan Motors built their first truck plant in the United States, and they were implementing just-in-time, and they would buy, components from all over Mexico, Canada, Japan, and they would track those components coming into the U.S. over the course of weeks, right? These things, come on slow boats from Japan, and they would have RFID tags on the containers that had the components coming in, so they knew they could track those components and when they were going to arrive. And so RFID tags are used for just-in-time as a means for those larger items that you're purchasing to track their arrival dates so that you can coordinate your manufacturing around that. It also allows you to track quality because you know which products you're getting from which vendor, and you can track the quality of those products. And you could also then pay via EDI, which we've already said. Okay, so that's RFID tags. Okay, implementing this stuff in Microsoft Access. This is just the overview of the system. Remember the key events? You have your recs, you have your quotes from the vendors, you have your purchase orders, you have the receipt of the goods, you have your returns, and you have your payments. Those are kind of the major events. Here is your ER diagram, kind of sort of like what you all hopefully did. I've circled the stuff in the middle because this is the stuff that came in our narrative, more or less. We didn't talk about quotations for candy or requests for items or returns. I don't think there was a discussion of returns in the narrative. So we were really focused in this space for our ER diagram. Here's a context diagram, hopefully similar to what you all did. Highest level. Your level 0 DFD might have looked like. Although it starts with a rec, which we don't need, and then it has quote, which we don't need. So it's down there. You don't want to look at this. Once you have your physical table, you would then implement your tables in Microsoft Access, REA with many of the many relationships in there, relationship tables. Then there are some forms. There's a requisition form, a rec, where every department would have access to the system, and if they need something, they'd have some information, and then they'd enter the stuff that they want to order. The purchasing department would be the receiver of the rec, and would then work with the vendors to figure out how they were going to get those goods. A vendor quotation form, probably at the vendor site, not on your company, and they would send it to you. But maybe you don't have that automated relationship, and your purchasing department needs to enter the information so that the department that had the rec can then maybe have some input into where it's bought from. A purchase order could be paper-based that you send to your vendor, or it could be automated. Here's an example of a paper-based purchase order, buying bicycle equipment. Looks good, fits on one page, has an authorization signature, so whoever's, not just anybody can authorize a purchase, has to have the appropriate signature to allow it to happen. But a purchase order could also be automated. So it's a purchase order, the items you're going to purchase, the widget and the gadget. It's going to be a one-to-many kind of thing. So you see a few things here. There's some calculations, some extensions, which you've already started working with. Extensions down here as well. The one-to-many table. You could have drop-down boxes, again. Closed loop, you would enter the item number, the description would come back. You have a macro here, so when you're done, you hit record purchase order. So that gets sent, rather than just hitting enter at the end and then going to the next one. You'd have maintenance processes you have to maintain, like your vendors and your banks. You might have some queries. This is an open purchase order query. In this case, so an open purchase order is a purchase order for which you do not have a matching receiving report. It's a purchase order without a receiving report. You're still waiting for the goods to be received. Even if you have a query, it's a good idea. Well, the purchase order, you wouldn't have a closed loop, but if you put in a vendor number, you should put in the vendor name. There's very few reasons why you would not do that. This is a multi-table query.